So that's it. That's enough on that. Now, we're going to keep going with inventory because inventory is sort of like a fundamentally hard topic, and it's also a very important topic because most companies sell stuff. Okay, yeah, of course, there are some service companies, but the bottom line is if you want to be a successful retail or manufacturer, what are you going to do? You're going to sell stuff. So, so inventory and figuring out how to value inventory is very important. Moreover, cost of goods sold for most companies is the largest and most significant cost, and so getting that right somehow is really important. Okay, so if you remember from what we were doing before that we had to have a lot of detailed records about how many items and what we bought and all that stuff. And that made it difficult to do LIFO or FIFO too, for that matter. You had to like know exactly how many units, exactly what they cost you, and stuff like that. And one of the concerns is, what if you're a company which has 5,000 different products, right? So you're a company that sells, you know, your Best Buy, and you don't just carry one kind of TV, you carry 50 different brands and 50 different models. So then it sort of becomes an enormous burden to figure out exactly which items you have and sold, which, you know, and so ultimately companies don't really like doing that. That is not the way they want to think about their inventory. They don't want to fixate on how many units of each specific item do they have at which cost. Instead, they want to take a broader, kind of more holistic picture of their inventory. They want to say, yeah, it's true, each TV costs us a different amount of money, but we're just going to look at our inventory of TVs as being one class of inventory, rather than this is the Samsung XN4 III, and here's how many of these units we bought and sold and so on, because that's just too small. So instead, they'll say, okay, well, let's put all TVs into the same category, and we'll figure out whether or not we have more or less than in the previous year, based solely on how much the value of the units are today relative to what it would have cost us in the previous year. Okay, so this is the idea behind dollar value LIFO is you're going to say, I know what I have at the end of the year. How do I know what I have at the end of the year? I have to count it. This is not an option. I am required, okay, auditors and the company are required to count inventory at least once a year. So I know for sure what I have. Now, when I count, I might have to also add in, remember, some of the stuff that's on trucks elsewhere. So I don't physically have it in my warehouse, but I have to somehow get a record of everything that is mine, okay? And I can put a value on that. So I can basically say, okay, I have 100 TVs of various shapes, sizes, and models, and here's how much it would cost me to buy them right now. And then I can compare that to how much it would have cost me to buy the same TVs last year, okay, at the end of the previous year, and say, well, if the balance hasn't changed, and the only thing that's different is prices have gone up, then I have the same inventory that I had last year or this year, right, because I'm using LIFO. So all it means is if my inventory hasn't changed relative to the previous year, then anything I bought this year has been sold, and because I use LIFO, it's like the last in is the stuff that I sold, and what I have left is the stuff I had from the previous year. If my inventory level has gone down, not only did I sell all the stuff I bought this year, but I also sold some of the stuff I had the previous year, and if my inventory goes up, it means I have all the stuff that I had from the previous year plus some new stuff that I purchased. Okay, that's sort of how you want to think about LIFO. It's like this layers. Okay, you have a layer from the previous year, then do you dip into it? Do you leave it alone, or do you add more to it? And each year you're kind of creating a new layer. Okay, so we talked at the very end of the class before the review about how you can tell whether inventory amounts are going up or just prices are going up. Okay, so what do we do for dollar value LIFO? Okay, this is not hard, it's just different from what you're used to doing, and people get a little bit confused, so we're going to take it slow and we're going to figure it out. Okay, so I look at my inventory and I value it using today's costs. And I want to know, do I have more inventory or less inventory than I had last year? And how am I going to answer that question? Well, I'm going to look at how much my inventory would have cost hypothetically had I bought it last year. How do I compare? How would I make that hypothetical comparison? All right, so let's say I'm telling you, okay, this pen right now worth 10 cents. And I'm looking at my inventory in the previous year, and my inventory was worth 8 cents. How do I decide whether I had 1 pen or 2 pens or 3 pens? I mean, how do I know that? Okay, so I need to know how much the cost of a pen was last year compared to the cost of a pen this year, right? Because now I know what the cost of a pen is, and I need to compare it to what it would have cost last year. So the way companies do that is they use what's called an index, okay? So we consider the base year, the first year we ever start calculating our inventory, as year 1, and the index has the value of 1. And then every subsequent year, we look at changes relative to that number 1. 1 is just sort of like a simple number to start with. So if prices go up by 5%, my current cost relative to my previous cost is 1.05, right? So think about $1 going up by 5%, then it costs $1.05. What happens if prices go down by 5%? 0.95, right? My index can go up or down. Will my index go up or down? We would hope, generally it would not change too wildly, but depending on the type of company and the type of products they sell, it could go either way. In technology companies, you told me, like, oh, it's probable that the cost of the technology actually starts going down, right? Initially, it's really expensive to build these things, but then you sort of figure it out, you get them going, and actually the cost of production is lower. On the other hand, in other industries, prices just keep going up and up and up, and there's kind of nothing we can do about it. Okay, so we don't necessarily have we're not making any qualitative statements, is this good or bad? We're just telling you, okay, there is a current cost relative to the base cost. Costs go up or costs go down? You tell me. Now, how do companies figure out what the costs are, or what the base, these indices are? What do they do? Like, do they just say, okay, for every single item, we look at what it cost last year and what it cost this year and calculate some index? If they did that, they may as well just use regular LIFO, right? It takes just as much effort. Okay, so they don't usually do that. What else could they do? How would you figure out how much prices have gone up? Okay, there's basically government statistics on price indices. So on how things have increased in price over time. And they have them by industry, they have them by product, but you don't have to make it up yourself. You kind of use broader indices than necessarily a company-specific index. Okay? So you say, I have a certain amount, my inventory right now is worth this, my inventory would have been worth this at the base year, do I have more or less? Okay? If I have more, then it just means some of the stuff I bought this year didn't get sold. No problem. Add that layer into your inventory. If I have less, it means not only did I use up everything I bought this year, I also used up some of the stuff that I had on hand from the previous year. And you'll see how this works. Okay, so let's just do this is a nice example where prices are just going up and up and up, so we don't have to worry about price changes contributing to inventory level decreases. Okay, so let's say on January 1st, 2011, okay, this company adopts dollar value LIFO. So on to January 1st, we say, okay, we're starting our company and we're going to be a dollar value LIFO company, and our value of inventory is currently $400,000. Okay, all the units that we have on hand times their prices, $400,000. And at the end of the year, 12/31/2011, they count up their inventory and they put a cost on it of $441,000. Now, just ignore this for a minute. If you didn't know anything about, let's say prices stayed the same over time. Prices have not changed. They were constant over the entire year. What would you tell me about inventory? What must have happened? Went up, and how does your inventory go up? You buy stuff that you don't sell, right? Not hard. So you had some on hand, 400,000, and then you might have bought a lot, okay? You might have sold a lot of it, but some of it you weren't able to sell. So the reason your inventory went up is you bought more this year than you were able to sell, okay? Now, suppose I tell you, well, not only did the value of your inventory go up, but by the end of this year, prices were 5% higher than they were in the previous year. So now you have a harder time because you don't know whether inventory has gone up or not. So if I had to buy exactly this inventory a year later, how much would it cost me to buy it a year later? Times, so 400 times 1.05, right? So 5% more, so what is that? 420, right? So I'm telling you have 441, what can you tell me? It means you have more inventory. It's not only that you have more inventory, some of it is due to prices, right? If prices stayed the same, you would say, oh, we have 41,000 more. Now you don't have, you only have 21,000 more in inventory, right? But because some of the changes were due to prices and some of the changes were due to increases in quantity. Okay, so we just did it sort of just to see how do you kind of compute this. Here's sort of the mechanics, okay? I take this cost here, the value at the end of the year, and I roll it back to the base level. Now I always want to compare whatever year I'm in to the base level, okay? So that I kind of keep data in base level prices, and then I just tack on the increases in cost, okay? So let's say if I want to figure out how much $441,000 of inventory on 12/31 would have cost me on 1/1, how would I compute that? Just exactly right, okay? So take this divided by 1.05. What do I get? 420? Yes? Okay. So, if I started the year with 400,000 in inventory, okay, and I ended the year with 420, let's just hypothetically, what would you tell me must have happened? I bought 20,000 that I didn't sell. Now you can't, I might have bought 1,020,000, okay, and I sold 1,000,000. I might have bought 520,000 and I sold 500, but whatever happened, I purchased another $20,000 worth of inventory this year relative to this base. But when I buy $20,000 worth of inventory using 1/1/11 prices, so I'm buying inventory in the year 2011. Right? I had inventory of 400, then I buy more. When I buy it during the year of 2011, how much do I have to pay for it? Do I pay the beginning of the year prices, or do I pay the prices that relate to the current period? Current period. So in order to buy $20,000 of new stuff this year, how much does that actually cost me? Or tell me how I should think about this. What should I do? So remember when we said, well, let's say I took this stuff and I bought it at the end of the year, and everyone said, oh, well, multiply by 1.05. So now I'm saying, let's say I have $20,000 in beginning of the year prices, but I had to buy it at current prices. How much did it cost me? Well, 20 times 1.05, 21,000. Okay? So when I ask myself, what is my ending inventory? Okay, my ending inventory is $421,000. It's not 441. It's not 420. It's 421. Why? Well, I have 400,000 that I had from beginning of the year. Okay? And then what do you know about LIFO? Well, it's saying last in, first out. So anything that I still have, okay, is the stuff that I bought in the beginning. So I still have these units, plus I have another $20,000 of units in 2010 prices. But I can't pay 2010 prices in 2011. I have to pay 2011 prices. So how much is this extra $20,000 valued at? Well, it's valued at $21,000 in 2011 prices. So the sum of my inventory is 421. Okay. Quiet and blank. What's the ask now? What are you having? How do I get 21,000? Okay. So, first, I want to take this number and I want to convert it to base year prices. When I did that conversion, I got 420. Now that 420 is just saying if I had bought all of the inventory that I currently have right now in 2010, right, or in the, sometime before the beginning of the year, it would have cost me 420. But I know that I only had 400 worth of inventory at the beginning of the year. So did I actually buy that extra 20 before this year started? No, right? Because I only had 400 at the beginning of this year. So when did I buy that extra 20? This year. How much would it cost me to buy $20,000 this year? Well, this $20,000 is in 2010 prices, so in 2011, it cost me another 5%. So I just take 20,000 times 1.05. Okay? So now, let's look at, now we're starting 2012. So this is the ending inventory at 12/31/11, but it's also the beginning inventory for what? 12/31 or 1/1/12, right? So what do you want to know? Well, you want to know if the company buys more stuff this year, is it selling all that stuff? If it's not selling that stuff, then or if it's not selling that stuff, we're going to add another layer. If it is selling that stuff, then we might have to dip into earlier inventory layers because last in, first out. We first sell the stuff we bought this year, and then we sell the stuff that we had on hand. Okay? So, let's take a quick... Okay, there's the mechanical way where I can just say, follow step 1, follow step 2, follow step 3, but we also want to kind of understand why we're doing everything. We don't kind of want to, we absolutely want to. Okay, so Now we're at the end. Yeah, go ahead. Mm-hmm. Yes, this is all relative, always relative to the base year. Okay, so it didn't increase 12% this year relative to last year. It increased 12% relative to the first year. So if I were buying $400,000 worth of inventory in 2012, it would have cost me $448. All right, so just to kind of give yourself a framework. Okay, so now I'm trying to figure out, do I have more or less inventory than I had at the beginning of last year? Okay, so take this and put it in base year prices. So remember, when we did that, we got 420 here. Okay, so in base year prices, we take 487,200, and what do? Divide it by 1.12. What do we get? Okay. Now, forget about indices and everything for a minute. Just look at base prices. In the beginning, we said we had 400, and then we moved up to 420, so that means we bought more inventory relative to the previous year, and then we had to tack on an additional price because we bought it in the current year at the current prices. Well, now this is saying I had 420 at the end of last year as if it were bought in the beginning of the year, and I compare that to 435. Why am I comparing, these numbers? And the answer is because they're now apples, right? If I look at these numbers, it's not really a fair comparison because some of the increase is due to price changes and some of the increase is due to quantity changes. So I want to look at just base year to base year, using base prices, look at year to year, and that'll tell me, did my quantities go up or quantities go down? Okay, after I've taken into consideration all the price effects. So if I started with 420 and I have 435 now, did it go up or down? Okay, LIFO. If my inventory goes up, which inventory did I sell? Right, and so the stuff I bought this year. If my inventory overall is going up, some of the stuff I bought this year didn't get sold. Okay, well, tell me how much did I buy this year that didn't get sold? Just 15, right? 15, but that's as if I had bought it in 2010, right? I can't, when did I actually buy it? 2012. Okay, so let's look at 12/31/12. We had 400,000. That's still the same. Why is that still the same? Well, we're using LIFO, so we use those original cost prices, right? The inventory that we had from 2010 is still here. So those prices don't change. We didn't buy relatively new stuff, okay? Then we still have $20,000, which is converted to $21,000 from 2011. We didn't use that stuff either. We bought more stuff. Now we have another $15,000. Okay? Are we done? Do we just take 4 plus 21 plus 15? No, why not? Because when did we buy the extra 15? 2012. How much does it cost us in 2012 if this is 2010 pricing? So I have to multiply this by what? 1.12, which gives me 16.8. Okay? So what is my ending inventory? It's 400 plus 21 plus 16.8. Okay? 437,800. So it's not 487.2. It's not 435, it's something else entirely, because it's reflecting old stuff. All right, the last in, first out means all the stuff I bought recently is gone. So the majority of stuff that I have is based on older prices. It's based on stuff I bought in 2010, it's based on stuff I bought in 2011, and then I bought a little bit more this year. So I'm trying to figure out, of the stuff that I have, when did I buy it, and what was the price of that stuff when I actually bought it. Now, you see how this is very different from straight up LIFO, right? You're not counting how many items. There's no kind of relationship between I had this many items and this is the per unit cost, and this is kind of a different concept. But the idea of LIFO is still very much the same. You're building on these layers where each year if you're increasing your inventory, you're getting a new set of prices. Okay? So, now I'm going to be quiet. I know, hard to believe. I'm not usually quiet under any circumstances. I would like you to take a shot at 12/31/13. Calculate what you think the ending inventory should be as of 12/31/13. Go through all the steps that we needed to go through, and then we'll talk about it. Okay, but do it. Like, don't just, sit there and, text your mom now, or your friends, or your girlfriend, boyfriend, whatever. Do it, because if you don't do it now, the questions won't come up that you're going to have when you have to do it for your homework or on an exam. Yeah. Mm-hmm. Mm-hmm. So 437,800. 437,800. Okay? All right, who's ready to tell me how to do this? Who's feeling super confident? All right, who's not feeling super confident but willing to give it a shot? Okay, go ahead. All right, what do we do first? Okay, so you took 525 and you divided it by 1.2. 437,500. Now, let me just stop you for a minute, and I want to ask you, why are you doing that? You want to tell me? Okay, so we're going to compare all of these, we need to compare from year to year to year. The benchmark, everything is in comparison to base year prices. So we convert everything to base year, and then we can compare from one year to the next. We just want to have a common ground for everything. We could convert everything to 2012 prices arbitrarily, right? We could convert some forward and some backward, but why? We pick a base year, and then everything is simply converted to that base year. So now I'm going to look at 43,700, okay? Now I can compare this base year, this inventory in base prices to this inventory in base prices. Okay, go ahead, take it over again. Okay, so you had 435, now you have 437.5, so that means you have an extra 2,500 relative to 2012 inventory. But when did you buy this? So when you buy stuff in 2013, how much does it cost you compared to the base year? 20% more. Okay, so what did you do? Okay, so 2,500 times 1.2. And then okay, so good. Now, did everyone feels like they can do this? They are good to go. We're done. We're not going to talk about dollar value LIFO. You can do this. You can't do this. Can you do this? All right. Should we do another problem? Now let's do another. We're going to do another problem, and it's a little harder. Not harder in like kind of overall, sense, but harder in that prices might go up and down. So it gets, you got to make sure you know whether inventory quantities are going up. It's not always going to be the case that inventory is going up. Okay, even if the costs go up, it's not always going to be like the values could go down. So we're now going to have to play around a little bit with a harder problem because we sometimes need to use inventory from the previous period. Okay, so let's try one. All right, so we're now starting our inventory, or we're starting our dollar value LIFO computations as of 12/31/05. Okay, and these are at the base year value of 100. Okay, sometimes you'll see the indices in 1.2, 1.3. Sometimes you'll see them in percentages. Okay, this is in percentages. So 100% is equal to 1. 110% is equal to 1.1. Right? So that's okay. Now, everybody go ahead and do 2006 inventory and tell me whether or not, without looking at this part, tell me whether or not inventory levels have gone up, and if so, what should we value our ending inventory? And then go ahead and do 2007, and we'll talk about both of those. All right, you ready to talk about it? Or you need a minute or two? Minute? Okay. Okay, let's do 2006. So what do I do first to figure out? So I know that if I bought all the inventory that I currently have on hand at right this minute, at the end of 2006, it would cost me $12,100. But that's not really what my inventory should be, because I'm using LIFO. So I should mostly have stuff that I bought a while ago, and only if I had to buy more, that stuff should be valued at the current cost. Otherwise, it should be valued at earlier costs. So I know this isn't going to be what my inventory is. So what do I need to do to that current number to figure out what the right inventory is? Okay, go ahead. Tell me what I have to do. Right, for 2006. Okay, so this is if purchased in 2005. And I started with $10,000 that was purchased. So do I have more or less inventory than I started with? More, okay. So I have the $10,000 that I originally purchased in 2005. Okay, but now I have another $1,000, but I purchased it in 2006, so how much did that $1,000 actually cost me? $1,100. So my ending inventory is going to be $11,100. Okay, why? Well, first, I'm saying if I purchased it way back when, it would have cost me $11,000. But I didn't. If I had, that would be great, and then my inventory would have been $11,000. But because I only bought $10,000 of it last year, the remaining $1,000 of it I had to buy this year. But $1,000 of stuff at current prices is not the same as $1,000 of stuff at last year's prices. So this year, the stuff that would have cost $1,000 last year actually cost me $1,100. So my ending inventory is $11,100. Now, when I think about what am I doing? Like, yeah, okay, this is like a little game or a puzzle. No, what I'm going to do is I'm going to take that ending inventory number. That's going to be what's going to determine my cost of goods sold. My cost of goods sold is I get rid of my beginning inventory, which is $10,000. I get rid of all the purchases for the period, all the freight in, all that stuff, and then I add my ending inventory. And then whatever's missing is my cost of goods sold. So getting ending inventory is not just sort of like a little gimmicky fun activity, which some of you think is more fun or less fun. I think it's a lot of fun, but it's not. You're not doing this for the purpose of only computing ending inventory. It's the combination of getting the balance sheet right, and ultimately this is going to spill over to getting the income statement right. Okay, this is what's going to drive your cost of goods sold. Okay, now how about what happens in the following year? Okay, this one's a little trickier, so who wants to take a stab at this one? Yeah. Okay. Okay, so when I look at, so this is in 2007, and I had 11 in 2006. So do I have more or less? Less. So what does that mean? It means everything I bought this year, I sold, and then some. I even sold some of the stuff that I had on hand. Which stuff that I had on hand did I sell? LIFO, right? I had to have sold the last in relative to, so I sold the stuff that I bought here. Okay, so now we're kind of on target. So I have 10,500, which means I still have this 10,000, but now I only have 500 of these guys left. Okay, not 500 units, but $500 worth of this stuff. But again, I didn't buy that stuff in 2006. I bought it in 2007, and so it cost me 1.1. And so my ending inventory is 10,550. Okay, move that over here. 10,550. Now, what is going to happen here that's different from what happened in the last example? Well, now I still have a layer for 2005. I still have a layer for 2006, although it's smaller than it was the previous year. Do I have a layer for 2007? No, because everything I bought in 2007, I sold. So 2007, there's like a gap. There's no stuff left that I bought in 2007. So when I now think about further increases, I'm not going to use this value because I didn't buy them in 2007. Everything I bought in 2007 is gone. So if in 2008 I have more stuff, when will I have purchased it? In 2008. Right? I can't like retroactively go back and say, oh, can you just give me the prices from last year and I'll use those? And no. Otherwise, I wouldn't worry about prices changing. You know, my prices wouldn't be changing. So you need to sort of understand why there's not going to be a layer at the 1.25 level. We're kind of done with 2007 is just disappearing from our books. Okay, so with that in mind, I want you to take 2008 and give it a try. Okay, so when I look at my 2007 inventory, has it gone up or down relative to? Gone down. So when which inventory am I using? Well, I'm using the stuff that I bought in 2006. What I have left is still the stuff that I bought in 2005 and the stuff that I bought in 2006. I don't have anything left from what I bought in 2007 because I've used it all up. Okay? So I don't just apply this year's prices. I only apply this year's prices to new stuff that I had to actually buy this year. If I didn't buy anything more this year, or at least none of it's in my inventory, I don't use that price index. Okay, so now try 2008, knowing this one, we're skipping a level, right? We're not going to have any inventory from 2007 because we used it, we already just declared we've used it all up. So there's nothing in there for 2007. What we have is 10,000 from 2005, 500 but at the price of 550 from 2006, and 0 for 2007. Okay, so what do I do in 2008? Mechanically, everything's exactly the same. I mean, I'm not sort of changing the way I think about the problem. So what do I have to do in 2008 to figure out if I have more or less inventory? I take 16,800 and divide by 1.4. What do I get? 12,000. So I compare it to 10,500, which is what I had at the end of 2007, and do I have more or less? Okay, how much more in base prices? 1,500. Okay, so relative to just purely base prices, I have the first 10,000 that I bought. I have the next 500 here, nothing here because I don't have anything from 2007, and then another 1,500 that I purchased in 2008. But that's not what I paid for it. That's just if I were in base level prices. So when I converted 10,000 to 10,000, 500 to 550 because prices had gone up by 10%. 0 to 0, and then what do I convert this 1,500 to? 2,100, which is what? 1,500 times 1.4. So what is my ending inventory? It's 12,650. If I use inventory now so if the following year my inventory goes down relative to 2008, I'm going to first use these guys, then use these guys, and then use these guys. I don't have any of these, so I can't use them. Right? All right, are you comfortable? You feel like you can totally hit one out of the park? All right, do 09 and convince me. Yeah. So 12,650, is that right? Did I add right? Yeah. No? Okay, now this one is more interesting because prices are going down, so when you look at an inventory quantity going down, you look at the inventory and you say, well, it's gone down, but you don't know whether it's gone down because prices have gone down or it's gone down because quantities have gone down. Right? So you're going to have to figure that out first and then decide what to do. Okay, so what do I do for 2009? I look at how much it would cost me to buy my stuff right now. That's 12,360. How much would it have cost hypothetically for me to buy that in 2005? 10,300. So that's 12,360 divided by 1.2. When I compare that to the 12,000 that I had last year, do I have more or less? So when anything I bought this year, is it still here? It's all gone. So anything that's gone, anything that's at this 1.2 cheap price is gone. This would be an example of when LIFO might not end up resulting in lower taxes, right? Because prices actually went down. So the cost of the inventory is much lower than it was in the previous year. So that would be, kind of one of these weird cases where it doesn't work out the way you expect. Okay, so how much did it go down? 1,700. Okay, so, and that's in base quantities. So which are the ones that you're going to use first? The ones that you bought last, right? So these. Do you have enough of these? No. So you're going to get rid of all of these. Do you have any of these? No, so you don't have any of these. Then which do we use? These. Okay, so we have 300 of them left. So when we compute the value of our ending inventory from the perspective of 2009, what am I going to do? Well, I have the 10,000 that I started with plus $330 that I bought in 2006. Why 330? Well, it's 300 worth of stuff if I had bought it in 2005, but I didn't. I bought it in 2006, so having bought it in 2006, it cost me 330. Now this shouldn't really surprise you, in the sense that if I kind of compare this to the very beginning, I only have 300 more than I started with. Okay, when did I buy those 300? Well, I bought them the following year. Okay, because this is what I bought in the first year. I still had enough left over to cover them, and I bought those in 2006. So last in, first out means the hypothetical ending inventory is made up of stuff that I bought early in the period, not recently. Okay, and yeah. No. So ask it a little bit. Just. Well, but what if I didn't have any in 2006? Then I would have had the ones that were in 2007. Okay, I have to use whichever ones I actually have. So first I use these. I didn't have any here, so I had to go over to these. If I didn't have any here, then, if I had 0 here but some here, then I would never use that price level. So the answer is no, you got to actually roll it back. Just the last one? Okay. The last one, we decided, so you agree that inventory has gone down, right? Because when we looked at last year in base level prices, we had 12,000, and now we only have 10,300. So we definitely have less inventory than we did last year at base prices. So if we had bought it all at one price, we would have had 12 last year, and now we only have 10.3. So clearly inventory has gone down. When we use LIFO, the last in is the first out. So if inventory goes down relative to the previous year, it's because we sold some of the stuff that we had on hand. What did we sell? Well, first we sell the stuff that we bought last. So that's this stuff. But we sold 1,700, we only had 1,500. So we have to also sell 200 of these. Okay? Then you just apply price levels like we have before. Okay, so if you were going to do this problem by yourself, and you wanted to sort of think logistically, what would be the most kind of the cleanest way to do it? It would be perhaps to create a table in base prices and then convert it to current prices. Because then in this table you can sort of think about these as being almost like just the dollar values are perfectly interchangeable. You can add and subtract, guys, you can add or subtract amounts easily there. Okay? Because everything is in equivalent units. However, once you get here, when you put the value on it, you need, please, but when you get to the values here, you need to actually apply the price changes. Okay? So that you have a value for your ending inventory, not just, because Because ultimately, you didn't buy everything in 2005. You can't leave it in 2005 prices. You have to reflect the fact that some of it was bought in 05, some in 06, some in 07, 08, and what you have in your inventory is comprised of a combination of what you bought in the beginning and what you bought in the end. Okay? Other questions? Yeah. 10,330. Yeah. Okay, so you take the 300, you multiply it by 1.1, which is the current level, and then you don't have anything from any of the other layers. Any of the further, so you have the original 10, you have 330 from here, and 0 everywhere else. This came from 2006. This is 05, 06, 07, 08. Yeah. Yes. Other questions? No? Okay. All right. The next thing we're going to talk about is what happens if prices drop on your inventory to the point where you can't really sell it for what you paid for it. Okay, so in this case, in these other cases, just because prices go up or down, if you mark your stuff up really significantly, it doesn't matter. Yeah, you'll be more profitable if prices are low and less profitable if prices are high, but to some extent you probably have to pass on low prices to the customer and high prices to the customer because you're in a competitive industry. However, sometimes in some companies, your inventory will drop down below the price which you paid for it, and in fact drop down so far that it's not worth anything. Right? So let's suppose, have you ever read, they sometimes have these articles about companies that have, not sort of super high-end, but like designer images, and they'll like cut up their inventory because they don't want to give it away and they don't want anyone like who's not desirable to be wearing their clothes. Have you ever heard about this? Okay, so like some companies that try to be high-end brands would rather destroy their inventory, that you would say, okay, well, we have a particular item that's this season, okay, and we're not going to sell it next season. We've put it on sale at 50% off, still no buyers. We would rather destroy it than let some, idiot who would destroy our brand image wear our clothing. So we're not going to mark it down to 90% off. We're not going to give it to Goodwill. We're not going to be nice about it. We're going to be a bunch of jerks and we're going to spray paint it, or this happens all the time. I can't believe you haven't heard about it. It's horrible. And when companies are caught doing it, they have a lot of egg on their face. Like they'll be, you'll look in the dumpster behind some sort of like moderately nice stores and they'll have destroyed their inventory, and people get very upset about this for obvious reasons. Okay, anyway, holding that aside, obviously as soon as they start destroying their inventory, it has no value to them. What would they have to do at that point? Well, they just have to write it down to 0. Okay, that's obvious. Like you cut up your shirts, you're not going to sell them anymore. But what about if it drops down, but it doesn't drop down to 0, and you might be able to resell it? So you're the kind of company that, yeah, okay, our stuff didn't sell this season, but we're willing to bring it back out onto the showroom next year and sell it as 1-year-old stuff, but we're going to have to sell it discounted at 90% off. And at 90% off, we're actually losing money, okay? It's better than throwing it away and not getting anything for it, but we aren't making money. So what do you have to do in those situations? And in those situations, you have to write down your inventory to the lower of cost or market, okay? And the idea here is you can't leave stuff on your inventory as an asset at a high value if you can't actually, if it's not going to provide future benefits, right? It doesn't meet the definition or the criteria of an asset anymore. An asset has to provide you future benefits. If you know for sure that you have the asset on your books at like $20 a shirt and you're only going to get 2 for it, then you're misleading your investors, okay? So what is lower of cost or market telling you? Well, it's saying clearly historical cost is our first line of defense, but if the market value of the product drops below the cost, we need to take that into consideration. Now here's the bigger problem. What is the market value of anything? What should I use as the market price? Like, let's say we're talking about selling some, shirts that were on sale this year for $50 a shirt, and they didn't sell. They were very unpopular. People thought they were ugly, and we're just hoping that next year some people will buy them for $5 each. What is the market? Okay, so there's some notion of, what somebody is willing to pay for it. But since nobody bought them this year, I don't really know, right? I think people will be willing to pay $5, but I'm not really sure. So that makes it a little tricky. So the first thing we do is we look at what it would cost us to buy them. Okay? And the presumption is if the overall cost of the product itself has gone down, then of course the selling price is also going to go down. But that's kind of not really relevant in the example I just gave you, which is, people just thought it was ugly. That's a better example of, like the TVs, they used to be expensive to produce and now they're cheaper to produce. There's some technological advancement, and therefore the replacement cost of that item has diminished. Okay, so replacement cost is one possibility. But replacement cost isn't the only thing that we care about. We care about what you can sell it for, right? So that's what we sort of talked about. But not only what you can sell it for in terms of gross, but net. So if you have to keep your stores operating and you have to use up floor space for it and it actually costs you something to sell it, you want to take what you can net receive for this item. So let's say you can sell the shirt for $5, but it costs you $1 in sales time and record keeping and all kinds of other stuff. The net realizable value would only be $4. Okay, that is the most you could record it for. So even if you called your supplier and you said, "Can you make me more of these ugly shirts? How much would they cost?" And they said, "Well, they'd cost $10 each to make." If nobody's going to be willing to spend more than $5 and it costs you $1 to produce it, $10 isn't really relevant, right? $4 seems like a more sensible amount. On the other hand, if you can still make money on the product, even if its cost has dropped, you don't want to go below the point where you're making sort of a basic normal profit, okay? So we use these two other measures, which would be net realizable value minus normal profit, because if we were to say write them down to 0, then we would look extremely profitable the following year if we sold them for even 50 cents. Right? So we can sort of so companies have been known to do this. They'll write down their inventory too much and say, "Oh, this is completely worthless," and then the following year sell it and look like they earn 100% profit because it's all revenue and no costs. Why are there no costs? Because the inventory is at 0, so the cost of goods sold is 0. So you can't do that. Okay? So this is sort of how you can't go too far. So this is what we call it. We have a ceiling, which is the max we can record the value at. We have a floor, which is the min we can record the item at. And then we have replacement cost, which, depending on where it falls, will tell us if replacement cost is up here, we use the ceiling. If replacement cost is in between, then we just use replacement cost. And if replacement cost is down here, we use the floor. Right, so, try to think of some examples. So let's say it's really, really, really cheap to buy this product right now for some reason. But if you can still sell it for a fair bit of money, and you're not passing off those cost savings to your customers, then you don't want to write it all the way down to here, because then you'll look like you're more profitable than you should be. You'll have this supernormal profitability. Okay? On the other hand, if the replacement cost is very high, so it costs you a lot to actually replace it, but nobody wants the product, That doesn't seem like a sensible number either. And so you use the ceiling, whichever is in the middle, either the ceiling, the floor, or the replacement cost, depending on where they fall. Okay, so let's talk about this actual, let's do it in practice. Okay, we've got 3 products. The historical cost of each of these products is $100,000. This is what you can sell it for, okay? 135, 150, and 125. So it's not that you can't sell it for more than you paid for it. However, once you take into consideration how much it costs you to get rid of it, okay, so it's not that you can, yes, it's true you can sell it for 135, but you might need to do $45,000 worth of advertising. Well, then all of a sudden it's not really profitable, okay? So this is how much it costs you to sell it, and here's the normal profit margin on your product, which means normally you would try and earn 25% above the cost, okay? So you would ideally like to have a profit margin of 20%, 25%, and here's what the replacement cost is. So right now, if you call up your supplier and said, how much would it cost me to buy these, then that's the replacement cost. Okay, so the first thing we need to do is figure out what is market. So how do we figure out what is market? We first look at replacement cost, then we calculate the ceiling, then we calculate the floor, and we pick the middle. Okay? We then compare market to cost. Whichever is lower, we take that one. Okay, so there's a lot of steps. It's not like boom, boom, it's so obvious to me, oh, well, this is lower than this, done, we're finished. Right? We've got to do a little bit more work. So let's figure out what the market is for all of these products. So what is the net realizable value of a product? It's the selling price minus the cost of selling it. Not the cost of sale, not the cost of the product, but the cost of selling, okay, or disposal cost. So in the first case, what is the net realizable value of the product? 135 minus 45, right? So what is that? 90,000, right? So even though it would cost me $115 to buy this product, I can only sell it for $90,000 after my cost of selling. So sort of right off the bat, you're going to say, well, 115 doesn't seem like kind of a useful number anymore. All right, how about for the second product? How much would it cost me, or how much would I realize in net from selling that product? $125. And for the last product, how much would I get net? $120. Okay, now how much do I normally earn as a profit? Well, normally my profit margin is 25% of my selling price, right? So when you think about profit margin, it's just price minus cost of goods sold, that's your profit, divided by sales, that's your profit margin. So if I think 25% is my profit margin, I just take 25% of 135, of 150, and of 125, and that would give me my normal profit, which is after cost, how much should I take home? All right, so what is 25% of 90,000? 22,500? How about 25% of 125? 30. Okay, and 25% of 120? Okay, so now if I take the net realizable value minus the normal profit margin, okay, it's going to give me, whoops, 67,500, right? So I'm looking, what is the market? Replacement cost is 115. This is the ceiling. This is the floor. Which should I use? What's the middle? 115, 90, or 67.5? What's the middle? 115, 90, 67.5. Okay. There's 67,500, there's 90, and there's 115, right? Which is in the middle, right? So this is the most I could possibly record it at. So I ignore this. I don't care what this is because the most I could possibly record it at is 90,000. So what am I going to record my inventory here? It's 90,000. So I'm going to record a write-down, a lower of cost or market. Okay, so instead of 100,000, I'm going to write it down to 90,000.